Welcome to Asset TV, I'm Jillian Kemmerer. Emerging markets have sparkled compared to their developed counterparts this year. From China to South America, where do the opportunities lie, and is the outperformance set to continue? Today, I am joined by Rahul Chadha, Portfolio Manager and Co-CIO of Mirae Asset Hong Kong, and Malcolm Dorson, Portfolio Manager for Mirae Asset USA, to dive into this attractive opportunity set. Gentlemen, thanks for joining us.
Thanks for having us.
Malcolm, emerging markets have had an absolutely incredible run this year. Do you think the rally is likely to continue, or is it time for investors to step back?
I absolutely think that the rally is likely to continue for a few reasons. We're coming off of a very low base. We came off of a really negative cycle, and the turn really just began towards sort of in the beginning, middle of last year. So say this has been going on conservatively since January 2016. That's about a year and a half when EM bull market cycles generally last 42 months. In terms of that alone, just a frame of reference, I think it looks pretty attractive. But more importantly, we're seeing a rare combination of attractive valuations, superior growth, and really rare positioning for the asset class. Institutional investors versus the All Country World Index are about 5% underweight emerging market equities. And in addition to that, in the last down cycle, we lost $155 billion in the asset class. We've only clawed back about 28% of that. So you have to think in the past 7-10 years, people are more comfortable with emerging markets, the countries within them, the corporate governance within these countries, and the accounting standards within those. So if you're just as comfortable or more comfortable than you were 10 years ago, and we lost 155 billion, only clawing back 28%, we really do believe we should get back to 100% or more, and that 5% underweight should close dramatically.
So Rahul, coming over to you, we cannot talk about emerging markets without talking about China. What are your thoughts on what's coming next for this incredibly important economy?
I think you're absolutely right. China is the most important thing for emerging markets, and we saw emerging markets actually perform once these deflationary concerns about China eased. That happened somewhere around mid of last year, when around June, July, we saw PPI for China turn from negative to positive. Where it's been helped by is the supply side cuts in China. So we've seen China take out excess capacity in steel, aluminium, cement, coal, etc., and that helped reduce the deflationary pressure. What's also helped China is the synchronous global recovery. Look, what Malcolm was talking about, emerging markets do well in a strong global recovery backdrop, and that's what's underlying trend now. So we've got Chinese exports picking up, we've got the supply side reforms in China, and over last 2 years, consumption's been fairly resilient in China. So household debt in China was very low, below 30%. That's now come to 38%, but consumption which is accounting for 70% of the economic growth.
Now, I think when we talk about China, there's no country where there's more divergent schools of thought. And if we think about the bear case for China, there's a lot of noise around its high corporate debt right now. So do you think this could potentially lead to a crisis? Do you see it happening?
Okay, see, look, think of China as a patient with a weak immunity. Now, if you take this patient in a vulnerable situation, which is world with poor growth, world in a recession, obviously tail risks will come in form of a capital flight from China. But in a backdrop of strong global growth, I don't think those risks materialize. China doesn't become a tail risk to the world. And if you look at the underlying data also, over last 2 years, corporate debt has come down by 4 to 5% from what it was 2 years back. And we've seen households take the slack, basically. So we're not really worried about debt issues from China at this point of time. Debt's been steady around 260% of GDP. You've seen debt growth, which is equal to or below the nominal GDP growth. So the government is cognizant of this, and they're taking all steps to fix this, basically.
So shifting from debt to equity, China A shares were recently added to the MSCI indices. Is this positive for the Chinese equity market?
Clearly, if you're willing to take a 5-year view, this is as profound as 2001 when China became part of WTO. When China joined WTO, their share of world exports was 3%. Today, as we talk, that's a 12-13% number. So why I'm saying this is, see, next year, June, when A shares get included in MSCI, they come with an inclusion factor of only 5%. But we've seen with the case of Korea, we've seen with the case of Taiwan, in due course, this inclusion factor becomes 100%. So won't be surprised if China, which is today 28% of EM benchmark, goes up to as high as 40-45% in next 5 years. So I think investors ignore China at their own peril.
At their own peril. Okay, so if China is sort of the headline story here, India is, can you even call it a subheader? It's also a headline of the emerging market story. How has it achieved one of the world's fastest growth rates, and what is your outlook for the country at large?
No, we are extremely excited about India from a medium-term perspective. See, this has been particularly challenging because government kind of carried out two profound reforms. One was demonetization, which was really kind of an emotional blow to all these people who were not paying up their taxes, people who were evading whatever the formal economy, and so that's where it's helped get these people towards the formal economy. We've seen goods and service tax. I mean, a lot of people were skeptical whether the Modi government would be able to do it or not, but government clearly bit the bullet, and they did this basically. So if you look at India, over the next 3-5 years, India is going to be a story of productivity-led growth in the economy. We've seen strong infrastructure build out, whether it's roads, railways, electricity going to the far corners of the country. We've seen financial inclusion where they've opened bank accounts for 200 million households. So that coupled with whatever the government's done to boost the formal economy through the goods and service tax, that aided by record FDI, foreign direct investment, which India is getting, which was close to $60 billion last year, makes the story all the more attractive from a 3-5 year perspective.
So both China and India unignorable.
Absolutely right.
Okay, so we are speeding across the globe here, and Malcolm, I'm going to bring you into this conversation. What about some of the geopolitical risks in emerging markets such as Brazil and South Africa? Do you think that investors really need to be staying away from these markets right now?
So geopolitical risks is sort of an ugly way of saying it. I like to say we're starting to see changes, and I believe changes lead to opportunities for reform. And in the two countries that you mentioned, we're seeing that wholeheartedly, especially in Brazil. So Brazil historically had been known for having some issues with corporate governance, both on the country level and within the countries within it. And last year with the Lava Jato scandal and the impeachment of President Dilma, what we really saw that stood out to me as something that I became really excited about was an independent judiciary system. So with the independent judiciary system, sort of cleaning up the government and cleaning up basically the executive suite at the corporate level, we're seeing changes which is bringing more confidence into the market, and the bond market jumped on that very quickly. And with inflows of fixed income market coming into Brazil, that strengthened the currency. So the real started to correct, and with the strengthening currency, we saw inflation coming down dramatically. With inflation coming down dramatically, that gave the central bank room to start cutting rates. And on top of that, people are borrowing, people are spending again, unemployment's coming down, and growth is picking back up again. So this is sort of a domino effect, and as growth comes back in, we start seeing more FDI, more support for the currency, more room for the central bank to cut rates or keep rates low for a longer period of time, and more confidence in the market. And this all starts with sort of a big picture confidence in the system that we're working in, showing that the independent judiciary system is kind of cleaning things up. So we don't really see it as a geopolitical risk, but as an opportunity for change and reform. And same thing in South Africa. South Africa sort of had a similar background with pretty large structural problems, and that all started with the government. And the ANC's been in power for decades now, and at the end of this year, for the first time in a very long time, it seems like we might have some political change at the top. Not that we're going to see a move away from the ANC party, but that we'll have a change in who's leading the ANC party, where we have two very different types of candidates. One, Cyril Ramaphosa, who comes from the private sector, who we believe would be very market friendly and lead to very positive reforms in the market, and another candidate who will probably continue with President Jacob Zuma's policies that we believe would be probably counterproductive for what we're trying to see in South Africa. So it's a bit of a binary situation, but the exciting part is that we're seeing the opportunities for change and to bring these markets sort of more in line with the developed world.
Now, we've reframed from risks to changes, and obviously those can have knock-on effects that are positive. But in your opinion, what would you say is the biggest concern for emerging markets right now?
I'd say two things. So emerging markets, as we know, are relatively cyclical. They go through 6 to 8 year cycles. And what happened in the last positive cycle is that we saw a lot of these countries within emerging markets get a little bit too excited, see too much opportunity for growth because they have such strong demographics and such strong structural opportunities, that they get too excited and they sort of overlever themselves. And where's the place to find the sort of easiest capital or the cheapest capital was to go into the developed world. So they start borrowing money and over-lever themselves in dollars and euros. And then when the world changes a little and we start seeing an adjustment to a stronger dollar environment, a higher rate environment, that leads to over-levered balance sheets and higher interest rate expenses and negative earnings revisions. So basically people get too excited and a little too far ahead of their skis. And we hope and we believe that companies within EM markets, or at least the ones that we're working with and investing in, have learned their lesson in the last negative cycle, and they're coming out of a low base, and will move forward with strong, more responsible growth going forward.
Now, obviously, Malcolm kind of reframed. I asked about risks, and he said changes and opportunities. So, Rahul, looking beyond some of these risks, what are the real bright spots in emerging markets?
Oh, clearly. I mean, when you talk about all these bright spots, you would really get me super excited, because sitting in Hong Kong, I see what's happening around. And China, India are at the forefront of it. So when you go to Shenzhen, Shenzhen is what we call the Silicon Valley of Asia. And there is a huge amount of interesting work which is happening over there. Look at what China is doing in drone, what China is doing in robotics. I mean, clearly China is working in 10 years to become as good as Germany in manufacturing, and that's where the automation is happening. The Chinese internet companies are clearly interesting, the likes of Alibaba, Tencent, etc. Each one of them has a mass of about 700 users, customers. They're looking to mine this data better. They're at the top of the big data analytics, etc. Now, having sold games to them, having sold whatever merchandise through e-commerce to them, they're extending to payments. They are going into taxi hailing apps, restaurant bookings, a huge amount of opportunity. So e-commerce is a big opportunity in China, and having done well in China, these companies are extending their opportunity set to India, ASEAN, etc. The other big opportunity is healthcare. I mean, not many people talk about this, but look, these are the perils of a prosperous society. These are the problems which come with sedentary lifestyles. You've got the rise of cardiovascular diseases, you've got the rise of oncology related diseases in India and China. So China would have about close to 240 million cardiovascular patients. India would have 50 million, about 100 million plus diabetic patients for China. India would have 70, 80 million. So there's a huge opportunity in the healthcare sector, whether it's the pharmaceutical sector, whether it's the hospital sectors. And then finally, there is an opportunity in financial services, because look, very often we talk of the Asian opportunity as a homogeneous pack, but that's not really correct, because even within an economy like India, there is a huge gap, there is a huge divergence in various stratas of society. So the rich want to save for their kids' education, their retirement, and which is why insurance both in India and China is doing well. At the same time, there are millions who want to buy their first house, their first car, and that's a big opportunity for retail lenders like HDFC Bank or BCA across the region.
So China and India are the bright spots, e-commerce, healthcare, and finance within those two, the places to look. What makes you excited, Malcolm, right now?
Russia sort of hit a perfect storm a couple of years ago, with the ruble blowing out to 80, oil dropping to 30, and sanctions being imposed upon the country by the West. Since then, recently we've seen sanctions being tightened up against Russia, and I think that's sort of held Russia back on this emerging markets rally. So Russia hasn't participated as much as we would have thought or would have liked to, and I believe that's really mostly on account of these headlines, the headline risk associated with it, but Russia's still trading at a PEG ratio below 0.5. So we're really excited about valuations in Russia. In terms of growth, 2 years ago we had negative 3% growth. Last year we saw close to negative 2% growth. This year we should see 1.5%, 2% growth. So if you look at it on an absolute basis, you're not that psyched about 1.5% growth. But when you look at the delta swinging between negative 2 and positive 1.5 or positive 2, that's pretty exciting, and it really moves the needle. On top of that, you might, on an absolute basis, not be that excited about $45, $50 oil, but comparing it year over year to $30 oil last year, there's a big move, and oil trickles down into the economy. It puts less pressure on the government to raise taxes. Unemployment's at 5 or actually below 5% now. Inflation came down from 16% to about 5% now, giving the central bank room to begin a monetary easing policy, and all ahead of an election when the government's really stepping up spending to keep people employed and keep the populace happy and the consumer incrementally stronger. So excited about Russia. In terms of Brazil, it's the reform story that we discussed. Again, coming from a really low base. 2015, negative 3.8% growth. Last year, negative 3.5% growth. This year, probably 1% growth, 1.5% growth. Again, 4% delta change. That's really, really exciting. On top of that, we've seen the base rate cut from 14.25 to probably 7.5 by the end of this year. Inflation's gone from 10 to 5, 4%. Unemployment peaked at 13%. And the companies within this country are operating at utilization rates between 40–50%. So we're pretty excited about them in terms of leverage from the balance sheet perspective, but also operational leverage that gives us room for margin expansion, extreme margin expansion in a short period of time.
You're an active manager. Why do you think that this is truly the best approach when it comes to emerging markets?
Active management in general versus passive management, ETFs, not only in EM, but as a whole, I believe as passive management grows, it sort of just creates more dislocations and more opportunity for emerging market managers in terms of valuation. And but more specifically in terms of emerging markets, when you look at the benchmark and the ETFs that follow these benchmarks, a lot of them are based off of liquidity and market cap, and that means that a lot of the companies within emerging markets that hold the greatest weightings within these ETFs, they're generally state-owned enterprises or pretty volatile commodity names, metals and miners, oil and gas names, or oftentimes both. So big commodity names that are owned by the government that don't necessarily have the same vested interests or alignment of interests as minority shareholders. So I believe if I'm sitting across the table, I'd rather be with an active manager who can differentiate different management teams, alignment of interest, and sort of look for quality growth over just what's going to be the beta in these asset classes.
Rahul, do you have anything to add to the discussion on active management in EM?
Now, clearly, we are strong believers of the fact that, look, there is a huge opportunity to generate alpha in EMs, because EMs are yet to become efficient markets, basically, because the new consumer tastes and aspirations are evolving all the time. I'll give you an example. We genuinely believe that benchmarks are backward looking. From our portfolios, we want to be positioned to what benchmarks would look like 3 to 5 years from now. To give you an example, internet was a very fractional part of the benchmark 7 years back, and look at today. Most of the Asian benchmarks, most of the EM benchmarks are technology oriented. Healthcare, very small part, and we believe over the next 5–6 years is going to be a significant part of the benchmark. So again, we are bottom-up investors. We believe that winning companies, winning businesses have common traits. We are looking for scalable economic modes, and if you catch them early, you really have a lot of tailwind behind you to outperform these benchmarks.
Gentlemen, thank you so much for taking the time to chat us through all of your thoughts on emerging markets. For any of our watchers who are interested in really capturing some of that upside, I think you really made a compelling case, so thank you.
Thanks for having us.
And thank you for tuning in. From our studios in New York, I'm Jillian Kemmerer, and this was Asset TV.